Hey there, Bryce Spraggins Momentum Realty. I wanted to talk a little bit about some small apartment complexes today. Specifically, this one is Monarch Apartments. If you guys don't know, I've got a goal in 2021 to help 10 investors move into their first multifamily deal. So I kind of wanted to break down this deal. Um, there's some room for value add, not a huge home run with value add, but I think it's still a solid investment. But this is on LoopNet right now. You can go check it out. I just talked to the listing agent earlier today. They've gotten a bunch of offers, and the seller actually turned down the last one, which was real close to list price. So I think he's pretty firm on his price. But it's listed at 139, so 1.3 million, 90,000. 2630 Jamies Road, Monarch Apartments. I broke it down a little bit. Um, so I'm gonna go over I'm going to go over these things as if you guys know them. I'll try to explain some things as I move along. But I did this on a 10-year analysis. The reason I did that is because your commercial loans are going to typically be amortized over 20, 25, or 30 years, but they're going to have a 10-year balloon. So if you held this for 10 years, this is what this is going to look like. I'm going with a market cap rate of 6.5. Capitalization rate is just if you bought the whole property for cash after you pay all your expenses, management fees, capital expenses, all everything associated with it, your net at the end, you should expect to make 6.5% return on your money, and that's basically what a cap rate is. So there's 16 units here. They're all 2-2s. They're all the same square footage. It's basically 4 quadruplexes all together. Um, we've got, I put in his purchase price of 1.3 million here. Um, did some calculations off of, pretty much putting 30% down. So to close this, you're going to need about $440,000. Now, where you can get the money from, I mean, we can trade in one of your existing rentals. Maybe you're looking to go from a single family to multifamily. Maybe you've got some cash laying around. Maybe you've got a 401k or IRA that you want to move some of it into real estate or all of it into real estate. So there's so many places where you can get this money from. But that'll give you about a 70% LTV. Doing it that way, you're going to have about a 6.9% cash on cash return. Once we account for the leverage that you're using, you're making about 12% return on your money, which is pretty good. Over the 10-year period, and I'm using some conservative numbers here. I took a lot of the actuals that the listing agent gave me, and I plugged them in here. I'll show you that in a little bit. Um, for instance, rent rolls. There's there's 16 units. I took the average of all of them. He's getting top 850 for one of the units, but on the bottom side, I think it's 750. I think is his lowest that he's getting for rent. So once I put all of them together, 16 units, he's getting 795 a unit. So there's definitely some room to increase the rents there, which you increase rents, you increase the profitability of the unit, you manage it better. That's what's going to make the price go up. That's how your commercial real estate is valued, on the money it brings in, not on comparables like your regular single family homes. So here, I called it market rent 850. I've got some later on in the video. You'll see where we're getting it up to 850 over the next 10 years, and then adjusting 3% for inflation. We're assuming 12-month lease most of the time. Capital expenses. These are your costs to maintain the property. This is going to be replacing a roof. This is going to be replacing AC units. This is going to be repiping, plumbing. This is going to be having to redo the electrical. So all that goes into a bucket of capital expenses. I'm accounting for $50 per unit per month. That's about 10 grand a year in capital expenses we're putting away to make sure that our property isn't losing value and we can still maintain it and still get the top of market rents that we should be getting. Let's see. We've got renewal probability. I'm giving it 60% renewal probability. So 40% of the people that are leased right now are going to move on. 60% are going to renew. And these are all rule of thumb numbers that I'm using just to kind of take a look at what we can conservatively expect to get a return on from this property. Releasing costs $80 per unit. That's for your turnover cost, or 200 costs per unit releasing. So to turn over a property, I'm accounting for $200 for that. Total expenses, I took this right out of the actuals. See if I can't move this over a bit. These are the actuals that he sent me over the last year. We'll do due diligence to make sure that these numbers are actually true and we can verify them. But these are the actuals that he gave me as far as the listing agent gave me as far as what has been spent in the last year. So I'm using that over the next 10-year holding period as kind of a baseline and adjusting for inflation and things of that nature. Oh, let's see, your cash flow. I don't like this cash flow because it's not taking into account your debt service. But this is your net operating income really over the next 10 years if you were to buy the property at the asking price with 30% down basically. So it's going to pull in 80 the first year. I'm accounting for closing March 1st. So that's a quarter, almost a quarter, 2/3 of a quarter gone for the year. So that first year looks a little light, but your net operating income should be 85 and growing over the next 10 years. The returns here though, here are your actual cash flow numbers. After you pay the debt service, your loan, I'm accounting for 8% for management. You could manage it yourself or even negotiate that cost down a little bit. I think 8% is a little high. After you count that, vacancy, capital expenses, once you account for everything and you pay your mortgage, $21,000 your cash flow in the first year, and then it goes to about 30. So 27 the second year, 28, 29, 30, and you're running about 30,000 a year. A little bit more in the later years. This number's nice because you're going to sell it in year 10, and not only are you going to have this nice little 30,000 extra a year asset that you've been holding on to, you're going to a little bit more than double your money over here when you cash out. So those are really the kind of the main things I wanted to look at was what's your cash flow going to be? You're positive. I'm being pretty conservative with vacancy rates, management, capital X, all that good stuff. Over a 10-year period, you're going to more than double your money. Getting back here, we're looking at a 6.9% cash on cash return, leveraged at 12% there. So, all in all, it really comes to, do you like the area where Monarch is? I can tell you I'd say about a year ago now, they built a Wawa catty corner from this particular Monarch Apartments. There are about a $5 million commercial renovation that's going on about less than 2 miles away from this. So some money is being put into the area. I think it's going to be strong going forward. But it's really, what's your risk tolerance? Things I would ask myself is, do I have a property that has some equity in it that I'd rather exchange for this and collect $30,000 a year, and at the end of 10 years, more than double my money. Um, do I have $400,000 laying around, or between me and a partner or two, and we'd like an asset that after you hire management, you can look at a spreadsheet every month and it's going to make you $30,000 a year? Is that something that you're looking to do? And if you are, we can go a little bit deeper into these numbers. Put in an offer, you'll have a due diligence period, and then you can really deep dive and make sure everything's coming out the way it should be. But if these numbers look good at the top, let's talk a little bit further. Again, I'm Bryce Spraggins, Momentum Realty, looking to help 10 investors get into their first multifamily deal this year in 2020. So help me out with that. Share this if you know somebody looking to buy multifamily. Thanks.